This idea of edge in the trading space comes up all of the time. What's your edge? What's your strategy's edge? How are you choosing to make these optimal decisions in the face of uncertainty in a way that will positively impact your expected value? Because in these environments, the expected value of a strategy is directly related to the positions that that strategy is endorsing and the positions that you end up taking at the end of the day. It's the same thing in poker. You can bet your entire bankroll pre-flop, or you can check, call, try to see some cards, get some more information. Maybe you're really good at reading players. That influences your expected value, the decisions you make, so on and so forth. In this video, what I want to do is I want to define this concept of edge, and I want to show you how you can trade in an environment where you have this perfect edge. Then I want to extend it to the markets. I want to show you the idea of edge in a quantitative capacity, edge in a qualitative capacity. Then I want to wrap up with some anecdotal stories and some closing thoughts and future topics. As always, this Jupyter Notebook will be available in the description below. I'll also be posting it to the Quant Guild library on GitHub, where I post all of my Jupyter Notebooks and associated YouTube videos. At the top of this notebook, you'll notice some related content on pricing, why we care about pricing and identifying mispricings, trading in a statistical capacity as a market participant or a market maker. So I certainly recommend that you check those videos out. Moreover, I am super stoked to announce a massive update to quantguild.com. All of the games have been developed to help you apply your probability and statistics to the financial markets. 90 plus lessons in math, finance, and probability created by myself specifically for quantitative finance. But it doesn't stop there. It certainly was a busy summer. I've also launched live courses that you can take with me on quantguild.com. For this August cohort, we are launching financial mathematics and quantitative trading, and there are still a few seats left. So please, if you're interested in supporting the channel so I can continue to make videos just like this one, check out quantguild.com. Without further ado, let's jump right in and start discussing this idea of edge by defining it with a simple example. Let's start by setting the scene here. Trading is about making optimal decisions in the face of uncertainty. It is not a game of chance like roulette. No matter what action I take in roulette, I'm always going to lose money statistically as I continue to play because I'm subjecting my wealth to the house edge. If I come up with the expected value for one play of roulette, it's negative. And if I continue to play, I am going to subject my wealth path to this negative expected value or this negative edge, and I'm going to lose all my money. Here's a very simple example. On the left is a chart where I randomly choose black, red, or green with equal probability, and on the right is a strategy where I choose black, then red, then green, then black, then red, and I do that sequentially. No matter what I do, there is no optimal set of actions that I can take that's going to take this expected value from negative to positive. I'm always subjecting my wealth to the randomness associated with the probability mass function governing roulette, and it's fixed to be negative, so the house always wins. That's the house edge. This is what edge looks like as a player if your opponent, that is the house, has the edge. My wealth path is going to look like this over time. Effectively, the house knows how to trade with an edge, right? The transaction being a player going to roulette, putting money on black, green, or red, and then realizing some sort of payoff, right? The house knows how to trade with that edge. The players who are playing roulette don't. Otherwise, they wouldn't play. That's the optimal decision to make. So let's extend this idea now to another game of chance involving a market where our action or inaction directly contributes to our expected value being positive or negative and our associated P&L over time. So let's look at a game where if I roll a dice, I receive a payoff based on the value that I went long or short at. So for example, if I go long at 4, I roll a dice. If it's 6, then I make $2. If I go short at 3, I roll a dice, it's 1, then I make $2. So the outcome is going to be based on whatever price I go long or short at, right? This expected value, this 3.5, right? This is the expected value of a dice roll. That's not going to change over time, right? But keep in mind, there's no machine learning algorithm, there's no AI algorithm in this entire world that is going to be able to predict the outcome of my dice roll, right? The best we can do is this expectation. In fact, that's really all machine learning and artificial intelligence is it's essentially non-linear conditional expectations, right? We're not predicting anything. This word predict is thrown around all the time, but it's not a prediction. You're predicting a level. You're computing some sort of expectation. Very rarely is it going to be the value associated with your expectation. In fact, it can't even be 3.5, the dice roll. So when I say that there's no such thing as price prediction without insider information, this is what I'm talking about. If you don't have insider information, the best you can do is to come up with some sort of level, some sort of target level to base your decisions around. Sometimes that'll be right, sometimes that'll be wrong. And how you act based around that level and how you essentially deduce that level will determine whether or not you impact your expected value in a positive or negative way. Back to this game of chance, if we look at the expected value of a dice roll being 3.5, we can inform our decisions on whether to go long or short based on this level, and it's going to enable us to accumulate positive expected value over time. So what I have here is I have a market that is going to quote a bid and an offer. The bid is just a price that you can sell at, and the ask or offer is the price that you can buy at. So in our dice roll example, if the ask or offer is 3, then I'm allowed to buy at 3, and if I realize, let's say I roll the dice and it's 5, I can make $2. The bid and offer are going to be generated randomly around this level 3.5. And what I'm going to do is I am going to use this idea of edge to accumulate positive expected value, and I'm going to accumulate P&L as I continue to play iterations of this game, and that is because my actions directly impact my P&L. If I choose to transact when the bid is higher than 3.5, so let's say I can sell at 4, then I have edge on the downside. 4 is higher than 3.5, so the expected value of a dice roll is lower than the price that I can sell at. That's edge. If I instead buy low, lower than the 3.5, then I have edge on the other side. So this is the idea of edge, and this is how we can actually implement it strategically in our decision making to accumulate wealth. So what I have here is two charts that are very similar to this in the roulette case, with a game that our optimal action influences our expected value in P&L. And that is, if I choose to transact randomly, this is my wealth path in the dice roll game. It goes all the way down to eventually 0. But if I choose to act optimally, where I have edge, look at my wealth path. I'm accumulating a significant amount of P&L over time. Now, it's very important to note that this is not suggesting that every transaction is going to yield a positive outcome. This is the average path. This heavy green path here is the average path. Some paths do significantly better. Some barely break even. In fact, some go bankrupt before they have the opportunity to reach these nice wealth thresholds up here. So it's very important to keep in mind that we're just realizing one sample path, even though we have this edge. Now, on average, it may look like this, but we're going to experience one of these paths, right? That's this idea of the ensemble average versus the time average. But again, I'm going to punt on that and save it for another day. If I was to set up in New York City a booth, right? If I set up a table before, I get kicked out, if I set up a table and I try to make a market with this dice roll game and I tell people, hey, you can sell at 2 and buy at 5, right? If they don't have any concept of expected value and edge, my wealth path is going to look something like this. I'm going to be the casino, right? That's exactly what the casino's doing. And if I set up a table like that on the street, if the common man doesn't have understanding of expected value, then this is what my wealth path is going to look like on average relative to, one of these sample paths. It's going to be one of them, but I'm going to accumulate that edge over time. Whereas everyone transacting with me, this is what their wealth path would look like. Now, that's a case where I'm setting the market and I'm using this idea of edge to accumulate positive expected value, right? It's the same as with the casino, but the only difference here is my action and my optimal action, or my choice to buy or sell, is impacting my expected value. Whereas in the roulette example, there's nothing that I can do except not play. That's going to be my optimal action. This is how you trade with an edge. This is exactly what the casino is doing. Each outcome itself is random. I don't know the value of my dice roll. I don't know what roulette is going to land on. But this notion of EV is going to allow us to either accumulate wealth or lose wealth over several iterations of playing that game. And we saw that in one case, our actions don't matter, and in another case, they do. So let's extend this now to the markets, where our actions certainly do matter. We're dealing with this randomness, but this is now a game of really an incomplete information, because we don't have a static level. There is no static 3.5 that we can use. Just as I said earlier, there's no price prediction. The same thing is true with the dice roll. There is no way to predict the value of a dice, but we still want to discern some sort of level to make optimal decisions based off of. There are so many ways to do this. Let's take a look at some examples of quantitative edge. I want to start by saying that we're not talking here about arbitrage, a risk-free profit where our equity just goes up and to the right. And you can cite sharps in the 10s, 20s, 30s where it's a ridiculous metric in the first place in that context, because really you're just talking about getting stuck with the bill, if you will. You're not able to execute on your risk-free profit. But we're not talking about arbitrage here. That's my main point. There are systematic inefficiencies in the market that can be exploited in a quantitative capacity, especially with sufficient data. Once you start to get into the space of operating with big data, large amounts of news, text, maybe even videos, audio, you can extract a lot of signal and make optimal decisions in this uncertainty, constructing portfolios that exhibit this expected value and accumulation of expected value over time. There are fundamentally different problems, right, that you face as a retailer or an institution. Institutions deal with the scalability issue. As you continue to increase the capital allocated to a strategy, that strategy's edge is going to decline. That just, makes sense. From a retailer perspective, how do you handle that large amount of data? How do you deploy your capital in an algorithmic capacity? It's not an easy task, right? There are teams of people working on those problems. Another, worth mentioning in this space is that our statistical edge is very hard to discern, right? We don't know if the sample path that we're on is just a bad luck sample path. So let's take a look at this example here where we have edge, but look at some of these sample paths. They do go bankrupt. They do go bankrupt before they're able to accumulate wealth. We don't know which sample path we're on, right? We're trying our best to deduce if we have edge based on some level that we come up with, because we don't have a static level, right? And we're trying to figure out if that edge is still even viable now, right? Because it can change over time. Just because a strategy worked for the last 5 years doesn't mean it's going to work this year, right? There are all of these different moving parts that we also have to be aware of. So what are we actually looking at here when I talk about quantitative edge? Well, this is what a trading signal would look like. This is a monotonic relationship that you'd like to see between the quantile breakdown of returns by the trading signal, where the lowest value of your signal has an average return that is negative, and the highest bucket of your signal has an average value that's positive. You would go net short these equities, net long these equities. This is like some sort of cross-sectional return strategy where you're trying to predict returns in the cross-section. So you go long a basket of equities, short a basket of equities, and this is the associated P&L. You're trying to accumulate that P&L, right, based on this edge over time. But as I said, not an easy task. There are a lot of places to look. You can look at option implied volatility. You can look at earnings events. There are systematic inefficiencies in the market that you can capitalize on. But again, nothing is guaranteed. This is on a statistical basis, right? It's the same way if I played this dice roll game, I could go bankrupt before I accumulate all this wealth. It's entirely possible that my wealth path is just unlucky, but it's very difficult to tease out, especially when you don't actually know if the level that you're coming up with is correct for your edge, whether or not you're just lucky or unlucky, right, with your strategy. All of these things, there are techniques to deal with them, so on and so forth. But this is what it would look like in a quantitative capacity in real life. This is the best that we can do in the context of edge in a quantitative way. The best way to think about quantitative edge is to think about the way that strategies are deployed at different firms, right? Each firm doesn't run just one strategy with one expected value, right? The firms operate in different capacities. Sometimes the CIO is going to make everybody be net long or short, and each team has to figure out how to be net long or short. Sometimes, everybody can act individually, and that heterogeneity may provide better risk assurances and whatnot. But what I'm trying to say here is if each team is operating their own strategy, each team is trying to come up with a way to have positive EV. And if you have a whole bunch of different teams operating a whole bunch of different strategies, all trying to maximize EV, then that sure as heck is better than just putting all of your eggs in one basket. For example, in this one strategy where you may go bankrupt, or even in the dice example where you may go bankrupt before you can accumulate that wealth over time. So I think that's the best way to think about quantitative edge. If that's quantitative edge, then what the heck is qualitative edge? Well, the efficacy of qualitative edge comes under fire very quickly due to the lack of structure in an algorithmic capacity behind the decision-making process, right? Typically, qualitative edge will come from some sort of information advantage. I'm not talking about insider information, I'm talking about experience, right? Let's think of something like a poker player. Let's say I'm a terrible poker player. So I take somebody who is a professional poker player and I tell them, hey, can you tell me what to do so that I have the best chance of winning out of all of these folks that I'm playing with? He's like, okay, yeah, sure. So I'm sitting there with my hand and he's like, okay, now do this. I'm like, why? Why should I do that? Is he going to sit there and explain the 10 million and one different reasons why I should do that? Is he going to tell me because this guy's bluffing, because this guy is about to, bet his bankroll and this guy, and is he going to go through? No, he's not. So in a qualitative capacity, it's much more difficult to define the decision-making process because there's so many moving pieces, but it's kind of ridiculous to suggest that it doesn't exist because you look at something like poker where things like, reading other folks and figuring out when is the time to bluff and like all of those things are too abstract to quantify. Sure, you could try to impose structure to explain some of that variation, and I'm sure you can do a pretty darn good job at it, but the point is that there is a qualitative edge as well. So I come up with a couple of different examples here, but I want to show an example based on a perspective that I have on volatility. And I'm using this example of tariffs in early 2025. Fear is always mispriced in the markets. The so-called leverage effect is well documented, a stylized fact suggesting that as volatility increases, there's a disproportionate response in the associated price level, and as volatility declines, the price level recovers but at a slower rate relative to the decline. Okay, if this is the case, what is my qualitative edge? Well, I look at this as a mispricing based on fear rather than the world is going to end. Now, for the sake of these charts, I have to define it in a quantitative way, but when I actually go about executing this strategy, as volatility is rising, I am just going to continue to buy more of the associated ETF, or I'm going to choose a vol threshold that I say, okay, you know what? This seems very high now. I'm going to dump a lump sum in. And that's my qualitative edge, is I look at this as a mispricing based on fear rather than some sort of quantitative algorithmic inefficiency that I am going to deploy systematically. So let's look at these two examples, right? If I deploy a lump sum based on this volatility increase, I look at volatility as a mean reverting process. That's my qualitative edge. So I say, okay, I deploy a lump sum when the VIX is over 30. If the VIX is over 30, I deployed a lump sum, my drawdown would have been 13%. But a few months later, now we're at the end of July, I'm back up 112,000. So I went from 100,000 drawdown of 13% to 87,000. Now I'm up to 112,000. That's one way to do it. Survive that drawdown, you'll be okay. Okay, what about buy the way down? Okay, well, I can instead deploy maybe 5-10% of my capital at a time as the volatility is rising, and then I either run out of cash or the volatility drops below the level that I'm willing to buy at, and I stop buying the underlying or the associated ETF. And if I did it in this capacity with a level of 30 and a 10% investment every day that it's above 30, then my drawdown is even lower. It's 98,000, so roughly a 2% drawdown, and I'm back up to 115K at the end of July. So the qualitative edge in this sense is when I reach this $87,000 drawdown, so it's a $13,000 drawdown, right? 13% drawdown from 100K, or a 2% drawdown with this, more gradual approach. I'm not worried about the strategy, right? I'm not waiting for this to recover and I'm like, oh, I hope this recovers, right? It's fundamentally a different perspective on the situation. So the qualitative edge comes from outcome, and eventually when volatility normalizes, I am expecting to realize this positive value. And if I don't, then maybe I trade out at a lower level, and I'll discern what that's going to be based on how the volatility ends up playing out. So maybe the volatility stays high for longer than I anticipated, and I'm not willing to sit with this drawdown. So I'm going to get out, wait for vol to get higher, and then drop it back in at a lower level. But that's discretionary. That's at my own discretion for whether or not I'm going to do that. Moreover, this sample path only realizes one time. It's a very important idea because we try to look at these systematic inefficiencies, and sometimes they're there, but other times if we're trying to trade in this discretionary capacity, you only realize one sample path one time. So think of it like an election or betting on an election. The actual candidate that's elected is only going to be elected at that one point in time once. There is no ability to repeat that experiment a large number of times to see if the probabilities or the money was correct or any of that, right? It's only going to actualize one time. So this idea of qualitative edge is certainly more elusive, but we can't suggest that it doesn't exist, because if you look at something like poker and the ability to read people or read the table, right, figure out what to do and when, that is fundamentally qualitative, right? We can again try to impose structure to explain variability in each of those different areas, but that's again a more complicated and definitely a non-trivial problem. All that being said, this should be evident why nobody is going to teach you to trade, right? If we go back to this dice roll example, yeah, I could teach you to trade here, 100%. If I told you, okay, you have this dice market, the static expected value is 3.5, you should go long when the ask or offer is below 3.5, short when the bid is above 3.5. That's a set and forget strategy. You might go bankrupt by the time you accumulate a significant amount of wealth, but I can teach you to trade that 100%. This quantitative edge, I could teach you to trade that, right? I could show you a trading system, whether it be active or retired. I could show you what we've done in the past to generate wealth, but there's nothing guaranteeing that that system is going to continue to operate or work. And that's the exact same argument with the qualitative edge. So the reason why I'm highlighting this is because I want to emphasize that learning is really the key here. Learning. You are the key to the problem that is trading with edge, not someone else or some sort of money printing trading system. You are the key. You have to learn the space and learn to make optimal decisions in the face of uncertainty, knowing that the space is fundamentally random, fundamentally uncertain. In other words, if you try to look to things like the news just wants your attention. Every uptick in the S&P 500, oh, it's, everything's all good, but every downtick is the end of the world. That'll get your attention if you have a retirement portfolio. Brokers, they just want your commission. You can download an app and buy stock before your deposit even clears. You could do that with cryptocurrency. Learning is the only way to make these optimal decisions in the face of uncertainty. I don't ask anybody if my actions are optimal. I make those decisions myself, just like a professional poker player would. Just as I said, no good poker player is going to sit there and tell you what to do, especially if you're asking for the rationale behind his decision. Why would a trader do that? So What you shouldn't do is buy or sell irrationally, right? Every uptick is to the moon, every downtick is the apocalypse. Just buying and selling with no intent or purpose or no strategy, right? No edge. I have a great anecdotal story that I'd like to tell on the subject. So I train and compete in Brazilian Jiu-Jitsu. When I was in the locker room after training one time, one of my training partners, let's call him John for the sake of the story, walked in with two of my friends. Now, my two friends know that I have this background in quantitative research and quantitative trading, but John did not. So John began to lecture us about how he spent the last year of his life learning to trade. And he had, a crazy experience. It was a good learning process, but he ended up losing $2,000 on Dogecoin. I know that's not a crazy loss, but something that I was trying to tease out is what he meant by learn, because he said that he learned a lot, but he lost $2,000. So I was very confused. So I started to ask him what he meant by learned. I was like, oh, well, that's crazy, man. Sorry to hear you lost $2,000, but what kind of strategies did you try? And he was puzzled. I asked him, what was the macro regime? What kind of macro environment were you trading in? Again, puzzled. What is the supply of Doge? Do you know what the supply of the currency is? Is it a finite supply? Do you know what a cryptocurrency is? My point is, he didn't know what he was even buying, right? There's no learning that actually occurred. So, in this space, when you're dealing with uncertainty and you're trying to learn and impose structure, you need to actually learn. If you can't answer those questions, then why would you buy Dogecoin? Goodness gracious. So my point is, what you should do is master your quantitative skills, learn how markets function so you can make those optimal decisions yourself. Once you get to that point, I think even Alex Honnold, the free climber, had a great comment, because somebody had asked him, hey, how do I know when I'm ready to free climb, right? Climb those crazy mountains without any ropes. And he's like, it's not something that you get signed off on, right? You're good to go free climb, right? It's the same thing with trading, right? Nobody signed off for a professional poker player or a professional trader, or even decisions that I would make in a discretionary or quantitative capacity, right? Those are decisions that I am confident and comfortable making from this experience in quantitative research, trading, and learning. So that is the point. The key is to learn. Some closing thoughts. It's important to fully understand the idea of edge and optimal decision making in the face of uncertainty in a closed and a quasi-closed environment, just like we saw in the beginning of this video, because if you can't act on edge when it's static and it's not moving, then how can you possibly hope to act on it when you are operating with a moving target that you can't even see, right? That's what I had discussed in that video on expected stock returns don't exist. These mean levels don't exist in that static convergence sense. That's one of the challenges we face. Again, we don't know if we're on a bad sample path. I've seen people cite the central limit theorem that if your strategy is good, will converge to that positive EV. So incorrect. It's difficult to gauge if strategy even had edge or if it was lucky, and now we're just at best breaking even or losing money, or if we're in some sort of drawdown. These are all very canonical problems, and there are a variety of different techniques and strategies implemented to try to get around them. Some future topics I'd like to discuss: building systems for executing these strategies. Again, this isn't just a set and forget. This is based on a lot of different things, right? Like, I'm not going to trade in the same way when fear is arbitrarily high and the VIX is at 40 as I'm going to trade now. You look at something like a hedge fund, where do they make all their money? Do they make all their money in a bull market, or do they make all their money when there's a ton of mispricings and crazy amounts of fear? The efficacy of time series approaches I also want to discuss, because I have a lot to say on the subject of prediction and machine learning and AI for prediction, and what AI is actually learning as essentially a nonlinear conditional expectation. I'd also like to discuss the classical finance literature factor models, cross-sectional return, predictability, and of course the difference between retail and institutional trading. But for now, that is going to do it on this video of how to trade with an edge. I hope you enjoyed. I hope you learned something. I hope you continue to learn. Please, if you enjoyed this video and want to see more like it, leave a like, drop a comment below, subscribe. Check out quantguild.com to support my channel and videos just like this one. Other than that, thank you so much for watching, and I will see you in the next video.